Martin King, property analyst at Edison Investment Research, and I'm here today with Stephen Ingles, who's the Chief Executive of London and Scottish Property Investment Management, which is the asset manager for Regional REIT. Welcome, Stephen.
Thank you, Martin. Good afternoon.
Stephen, you just reported results for the first half of 2022. Could you perhaps start by giving an overview of those?
Of course. Let's start with my opinion. That is that these half-year results demonstrate a really solid performance for the company. EPRA occupancy, if I may start just with the operational business, EPRA occupancy has increased to 83.8%. From 81.8% at December 2021. Leasing activity has improved. The year to date, we stand at 88% of the 2019 leasing numbers. Now, the relevance of that clearly is 2019 was the last normalized year. And that's very encouraging. I mean, to put that in context, what we're talking about is in 2019, we completed 71 leases. Producing a rent of £3.8 million. And so far this year to date, we have signed 62 leases, producing an income of £3.34 million. So very encouraging with a quarter to go, and definitely a large step in the right direction in terms of leasing and occupancy. Now, the other valid point, I think, in terms of what has been happening to our properties in terms of tenants getting back to the office. So 99% of our tenants are now back occupying their offices within our portfolio. Now that's quite a substantial improvement over the course of the last 12 months and indeed even the last 6 months. So that effectively means that only 14 of our customers out of the 1,086 customers that we have are still to return to the office. Rather embarrassingly, that the majority of that is government occupiers, and even more embarrassingly, Scottish government occupiers. So, but in fairness, we have been in negotiations with them to extend that lease. So we do know they're returning, which is very, very encouraging. So, an operational point of view, an improving EPRA occupancy rate, improving leasing market, and our tenants being back in the building is very, very positive for the business.
And more generally, Stephen, how do you see the prospects for the office market, particularly in the regions where you're invested?
Yes, thanks, Martin. I mean, obviously, I touched on the detail of our own portfolio just a little earlier. These indicators are certainly positive, but we still have some way to go in the office market generally. We are seeing improvements, albeit from a tough 2020 and 2021. And I think my view remains the same as I stated 6 and 12 months ago, that really we need to wait until the end of 2023 to see the market settling into what will become the new norm. Many companies are still trying and testing methodologies of working, whether that's hybrid, full-time, etc. But certainly the vast majority of employers definitely see the benefits of having more staff in the office more of the time. That's very encouraging at a start point. That will then lead through to market improvement as more and more occupiers settle on their method of working, which is likely to be exactly that, the vast majority of staff being in the vast majority of time. We're seeing that throughout the regions. London has undoubtedly returned quicker than the regions, which is slightly against what we might have expected. London's reliance on public transport is well known, and we did feel that the regions would return to normality more quickly than London, but that hasn't been what we've witnessed on the ground. So in regional markets, yes, I mean Glasgow the slowest, but glad to say returning now. But I obviously travel the country quite a bit and visit all of the main cities. We have offices, of course, in Manchester, Glasgow, and Leeds, as well as London. and I visit other assets in other cities. And there is a definitive or a definite move back into town. Everything is noticeably busier. So I think that augurs well. If I just touch on the regional secondary office market for a second, which is very relevant, obviously, to us, this is what we invest in. We still have very restricted supply. So unlike any other downturn, and we can call the pandemic a downturn, other downturns normally are at a time when supply is perhaps not as restricted as it had been in the run-up to the pandemic, because it wasn't an economic event. So limited supply before the pandemic, rental growth indeed before the pandemic, and then effectively the pandemic put the brakes on the market, if you want to call it that. I think that's quite an interesting situation though, because we come out at the end of the pandemic and actually many companies have not given up their space. Banks being perhaps the exception, who did indeed take the opportunity to reduce substantially their footprints. So on that front, regional markets remained relatively high in terms of occupancy levels. As we've come out of that, and as people have made decisions to move, upscale, or improve their office offering to retain and indeed attract new staff, that is a increasing demand on the base of a very relatively low vacancy rate. So that looks very, very exciting for the regional markets in terms of future rental growth. I do believe there'll be a lag. And indeed, we're not oblivious to the fact that many are predicting a recession round the corner. Whether that's a shallow recession or a deep recession, we'll have to wait and see, or indeed any recession. But I think most people are expecting an economic downturn just given current climate. That will impact all markets, including the regional office market. But I think in light of what I've just said, with that supply-demand balance, I think actually regional markets will come through this next black swan event, if we want to call it that, or next recessionary period in good stead.
Stephen, you've spoken already about the progress on the operational side in the first half of the year. Can you say a little bit more about the financial performance, but also, given your focus on dividend returns, what the outlook is there?
Yes, I mean, regional REIT, I've repeated this many, many times, is absolutely focused on paying a high continuous dividend, and that remains absolutely the focus. Obviously, we have announced H1 dividends of 3.3 pence per share, up marginally from 2021. That targeting 6.6 pence per share at the year end. We have talked a lot already about the improving market, our lettings, etc. So therefore, you would anticipate that earnings per share would have been higher than the 2.9 pence that we've reported. That's marginally down on last year, as you'll know, Martin, at 3 pence per share, and clearly not covering the 3.3 pence dividend level we've announced. This is typical of regional. We do pay 4 quarterly instalments of equal instalments and perhaps look to top up the year end, depending upon performance. Our first half earnings and second half earnings are always different. First half earnings always lighter than the second half, and indeed this year will be no different. And that's down to a whole number of factors, including such things as early surrender payments for leases, dilapidations payments where we are not going to expend that money on refurbishment as we're selling vacant properties for alternative use, and a number of other items. So the earnings in the second half will be substantially higher. Now, let me just touch on the earnings at 2.9 pence. That's really been affected by one major factor. So income is up, but earnings are down. Why is the obvious question to ask, and that's simply down to costs. So our costs increased substantially in the first 6 months, and that those costs increased substantially for one main reason, and that is the energy crisis that we are currently facing. So Clearly, we have a relatively high proportion of vacancy in our portfolio. There's the opportunity going forward to create and generate value. But with roughly 20% of the portfolio void, then clearly the landlord has to pick up the costs of heating and powering and the energy consumption of that element of the portfolio. And if we follow that through to numbers, that's roughly 0.3 pence per share in the first 6 months. So, had it not been for that, then we've been obviously substantially ahead of the 3 pence last year at 3.2, 3.3 pence per share. So that's really the explanation behind earnings. Now, one of the other main factors, of course, is debt. We're living in an era where we are expecting, have seen interest rate moves, and we're expecting higher interest rates next week when the Bank of England sit and determine the new rate of interest. So we are very fortunate in Regional REIT. We've always taken a very, very risk-averse attitude to everything, but debt being part of that. And we did, a number of years ago, secure long-term debt at the then price. Now, I do remember being criticised actually for saying, well, your debt looks high in comparison to some others. Now, the others took floating rates and benefited from those very, very low rates of interest over the last couple of years. But we're sitting in a position where our average debt is 5 years. We are at 3.5%, so marginally up in terms of cost of debt because we have reached the caps on a couple of our facilities. But we are 100% fixed, hedged, and capped. And our interest rate cannot be any more than 3.5%. So I'm sitting here relatively pleased of the way that our strategy's worked out on debt. Next time we need to consider any debt is 4 years away. If you look at the forward-looking yield curve on debt, it's anticipated that debt will increase in the very short term and then come back in years 4 and 5 to a far more reasonable level, at which time we'll be refinancing. I'm just very glad we're not having to refinance at the current time. So debt clearly is our major fixed cost, and that is very much fixed at 3.5%. Therefore, always we really need to focus on is income, which, as you know, we are making good strides to improve, and then costs. Well, yet another black swan event. I don't think we ever saw energy costs doing what they are currently doing. The good news is that the government are intervening, and we will see government support from October, as that was announced only yesterday. Unfortunately, what that support looks like is yet to be announced, but nonetheless, it will put us in a better position than we are currently, and therefore we expect costs to reduce in the second half of the year.
The operational and financial progress that you've talked about, as well as your outlook for the future, doesn't seem to be represented in the share price at the moment. What do you think would be the triggers for a re-rating?
Yeah, I hate pointing to the past, Martin, but I think it's very relevant in this case. When we came to market in 2015, we came with a very high dividend at that time. We floated at 100 pence and we were paying a dividend of 7.65 pence. So, even at that time, the market looked at us and said, well, this dividend is too high against an average of 3 in the sector. It can't possibly be true or indeed repeating. We demonstrated throughout the period 2015 to 2020, not only could we maintain that dividend, but we could actually improve it. And we got to a position in February 2020 where rental growth was coming back into the market. People believed our story, believed in our management style and approach, which of course in itself is slightly unique given that we do everything in-house. And that resonated with investors. And we got to a stage in February 2020 where we were trading at a 5 to 6% premium to the then NAV, now as we regard it NTA. So that was purely down to patience, doing the day job, delivering year after year or quarter after quarter, as it is in our case in terms of dividends, and the market then realizing the value of that income stream. Clearly we've had the pandemic. Add to that the fact that we are focused in offices, and of all sectors, offices has probably had the most uncertainty given the whole work from home, work from anywhere furore, as I would say, and actually a realization now that people are coming back to the office. So I think we have to be patient as a business. Shareholders have been very patient. Major shareholders have been with us since day one. And we continue to deliver, what I regard as an outstanding dividend, year in year, quarter in quarter, and our investors are happy with that. Now, clearly, what we want to do is attract more investors to get that share price up. And I think again, it's about delivery on the day job, delivery of that income stream, security of the debt, all the things that we've just talked about in this interview. Other levers, marketing clearly and promoting our story. And I think that's really what it's all about. Getting the story out there, making people aware of the business and demonstrating quarter on quarter a reliable and consistent income return by way of dividend.